Many investors overlook gold, often dismissing it as an outdated relic. However, this oversight could be costing them significant peace of mind and wealth protection. While the S&P 500 has averaged around 10% annual returns over the last century, gold has quietly preserved purchasing power, often acting as a counterweight during turbulent times. For example, during the stagflation of the 1970s, when the stock market struggled, gold prices surged by over 600%. Ignoring gold means missing a key tool against financial erosion, potentially leaving your portfolio vulnerable to market downturns and currency devaluations, costing you hundreds of thousands in lost security. Gold isn't a get-rich-quick scheme, it's a stay-rich strategy. Think of it less as a growth engine and more as an insurance policy for your wealth. While stocks aim to generate exponential returns, gold's primary role is to preserve your purchasing power against inflation and economic instability. It's the dependable anchor in your portfolio, a tangible asset that has held value across millennia. Unlike paper currencies or digital assets, gold's value isn't dependent on government stability or technological infrastructure, making it a unique safeguard in uncertain times. One of gold's most powerful attributes is its ability to act as an inflation hedge. When the cost of living skyrockets, the purchasing power of your cash erodes rapidly. Historically, gold has maintained its real value over long periods. Consider this. In 1970, an ounce of gold was roughly $35, and a good quality men's suit might cost you $150. Today, an ounce of gold is over $2,000, and that same quality suit is still around $400–600. Gold helps you buy relatively the same goods and services across generations, protecting your hard-earned money from the relentless march of inflation. Fiat currencies like the US dollar or the euro are backed by faith in the issuing government, not a physical commodity. Governments can print more money, leading to currency debasement and a reduction in your savings value. Gold, on the other hand, cannot be created out of thin air. Its supply is finite and subject to the slow pace of mining, making it a robust counterweight to the inflationary tendencies of central banks. Holding gold is a way to opt out of the constant devaluation inherent in our modern monetary systems, safeguarding wealth against unpredictable policy decisions. During times of economic uncertainty and market crashes, gold often shines brightest. When the stock market plummeted during the 2008 financial crisis, gold prices climbed significantly, providing a safe haven for worried investors. Similarly, during the initial COVID-19 pandemic panic in March 2020, while global markets faced immense volatility, gold again demonstrated its resilience, quickly recovering and then rallying. This flight to safety phenomenon makes gold an indispensable asset for weathering financial storms, cushioning your portfolio when other investments are in freefall. Gold's status as a store of value isn't a modern invention. It's a historical truth spanning thousands of years. From ancient Egypt to the Roman Empire, and through countless civilizations, gold has been coveted as a medium of exchange and a symbol of wealth. It's been accepted across cultures and geographies, making it the ultimate universal currency. This unbroken lineage of trust and value gives gold a unique psychological and practical edge over any other asset, confirming its role as the ultimate long-term wealth preserver, proven by millennia of human history. Unlike paper money, which can be printed endlessly, or even digital currencies that can be created with code, gold's supply is inherently limited. All the gold ever mined in human history would fit into a cube roughly 23 meters, 75 feet, on each side. The scarcity of gold is a fundamental component of its value. While new discoveries happen, they are increasingly rare and costly to extract, ensuring that its supply remains relatively stable compared to demand. This intrinsic scarcity protects its value, making it fundamentally different from assets that can be easily diluted. A critical reason to include gold in your portfolio is its role in diversification. Diversification isn't just about owning different stocks. It's about owning assets that behave differently under various market conditions. Gold typically has a low, sometimes even negative, correlation with traditional assets like stocks and bonds. When stocks go down, gold often goes up and vice versa. This inverse relationship means that adding a small percentage of gold can smooth out your portfolio's overall volatility, protecting your investment returns during rough market patches and ensuring a more stable growth trajectory. For decades, the 60-40 portfolio, 60% stocks, 40% bonds, was considered the bedrock of prudent investing. However, in today's environment of low bond yields and high inflation, this traditional model faces challenges. Adding a 5–10% allocation to gold can significantly enhance the risk-adjusted returns of a traditional 60-40 portfolio. Research by the World Gold Council and others consistently shows that a diversified portfolio, including gold, outperforms a gold-free equivalent over the long term, especially during periods of high inflation or market stress, offering superior protection and stability. Modern portfolio theory, MPT, pioneered by Nobel laureate Harry Markowitz, emphasizes selecting investments that minimize risk for a given level of return. MPT heavily supports the inclusion of assets like gold due to its diversification benefits. By combining assets with low or negative correlations, investors can achieve a more efficient frontier, meaning better returns for the same level of risk, or lower risk for the same return. Gold fits perfectly into this framework by providing a non-correlated hedge that can improve a portfolio's overall risk-adjusted performance, making it a theoretically sound choice for any diversified investor. If you want to truly own gold, physical gold is the way to go. This means buying actual gold bars, rounds, or coins, such as American Gold Eagles or Canadian Gold Maples. Purchase from reputable dealers like APMEX or JM Bullion, who offer certified products and transparent pricing. Always compare prices, as dealers add a premium over the spot price, typically 3–8% depending on the product's size and rarity. Buying physical gold gives you direct ownership, shielding you from counterparty risk and ensuring you hold a tangible asset, a crucial aspect of wealth preservation. Once you own physical gold, secure storage is paramount. Storing small amounts in a high-quality home safe can work, but for larger holdings, consider a bank safety deposit box, which typically costs $50–200 annually. However, banks may not insure precious metals, so check your homeowner's insurance policy for coverage. For ultimate security and insurance, specialized non-bank vaults like Delaware Depository or Brinks offer segregated storage, ensuring your specific gold is kept separate and fully insured. Research these options carefully to match your comfort level and investment size, securing your physical asset. For those seeking easier access and liquidity without the hassle of physical storage, gold exchange-traded funds, ETFs, are a popular choice. Funds like SPDR Gold Shares, GLD, and iShares Gold Trust, IA, track the price of gold and are backed by physical gold holdings. You can buy and sell them just like stocks through any brokerage account. The downside is you don't actually own the physical gold. You own shares in a trust that holds it. While convenient, this introduces counterparty risk and storage fees, typically around 0.25040% annually, deducted from the fund's value. Investing in gold mining stocks offers a different approach, carrying higher risk but also potentially higher reward. Companies like Barrick Gold or Newmont Corporation, NEM, profit from extracting gold from the earth. Their stock prices are leveraged to the price of gold. A small increase in gold prices can lead to a magnified increase in mining company profits and stock value. However, they also carry operational risks, such as mining accidents, labor disputes, and geopolitical instability. This makes them a more speculative investment than direct gold ownership or ETFs. Gold futures contracts are an advanced investment tool, primarily used by institutional investors and experienced traders. These contracts are agreements to buy or sell a specific quantity of gold at a predetermined price on a future date. They offer significant leverage, meaning you can control a large amount of gold with a relatively small upfront capital, but this also amplifies potential losses. The average retail investor should approach futures with extreme caution, as they are highly volatile and require a deep understanding of market mechanics and risk management. For most, direct physical gold or ETFs are far more suitable. So how much gold should you own? Financial advisors often recommend a modest allocation, typically between 5% and 10% of your total portfolio. This percentage is enough to provide diversification and act as an effective hedge against market downturns and inflation, without overallocating to an asset that doesn't generate income or rapid growth. For example, in a $100,000 portfolio, Allocating $5,000 to $10,000 to gold would be a prudent starting point. This small percentage can significantly improve your portfolio's resilience without hindering its overall growth potential, striking a sensible balance. While gold is a smart investment, there are times not to buy it. Avoid emotional buying during peak market panic when gold prices have already surged dramatically. Buying high often leads to disappointment. Also, don't overallocate. Gold is a defensive asset, not a primary growth driver, so exceeding a 10–15% allocation can drag down long-term returns. Furthermore, understand its purpose. If you're looking for quarterly dividends or exponential growth, gold isn't your answer. Buy gold strategically as a long-term hedge, not as a speculative bet to get rich quickly, ensuring it aligns with your overall financial goals. Many newer investors compare gold to Bitcoin, both often labeled as alternative assets. While both aim to be independent of traditional financial systems, their characteristics are vastly different. Bitcoin is a nascent digital asset, highly volatile, with its value tied to network adoption and speculative demand. Gold, conversely, has thousands of years of proven value, is tangible, and its value is rooted in its scarcity and historical role as money. Bitcoin's future is still unfolding, whereas gold's track record as a safe haven is etched in history, making them distinct investments with different risk profiles and purposes. Some critics dismiss gold as a barbarous relic, a term famously coined by economist John Maynard Keynes in the 1920s. They argue that in a digital age, a physical metal holds no relevance. However, recent geopolitical events, supply chain disruptions, and surging inflation have starkly reminded us of the fragility of modern systems. Gold's physical, undeniable value serves as an ultimate backup when digital systems fail or currencies are debased. It's not a relic. It's a timeless, tangible asset that offers real security when the stability of paper assets and digital promises falters, proving its enduring relevance. Consider the hyperinflation in Weimar Germany during the 1920s. German citizens who held all their wealth in marks saw their savings become literally worthless, needing wheelbarrows of cash to buy a loaf of bread. However, those who had prudently converted some of their wealth into physical gold preserved their purchasing power. A similar pattern emerged during the collapse of the Soviet Union. These historical examples vividly demonstrate gold's undeniable role as an economic lifeboat, safeguarding families from complete financial ruin during extreme currency crises, proving its resilience and fundamental value. As your smart friend explaining money, I want to emphasize that gold isn't about getting rich quick. It's about protecting what you've already built. Think of it as the ultimate financial insurance policy against the unpredictable nature of global markets and economic policies. It's not sexy, it doesn't pay dividends, but its quiet strength in preserving wealth during chaos is unmatched. A small, intentional allocation to gold helps you sleep better at night, knowing a portion of your wealth is safely anchored in a timeless, tangible asset, offering unparalleled peace of mind. Now that you understand gold's vital role, it's time for action. Start by researching reputable physical gold dealers or low-cost gold ETFs like GLD or IAU. Consider a modest 5–10% allocation within your diversified portfolio, starting small and gradually building your position. Always align your gold investments with your personal risk tolerance and overall financial goals. Remember, gold is a long-term play for stability and protection, not short-term speculation. Educate yourself further, consult a financial advisor if needed, and make an informed decision to fortify your financial future.